So this is very important for our learning purposes as far as taxation is concerned. So when you talk about value added tax, which is part of revenue which the government generates for it actually to be effective and efficient in its service delivery. So VAT is a tax on spending which is collected by business and passed on to the government. VAT is charged on supply of goods or services in Kenya and on the importation of goods into Kenya. So where VAT is focused on when you are supplying goods or when you are providing services. At the same time, when you import goods, it will always attract the value added tax. Before the value added tax may become chargeable in respect of supply of goods or services, the following requirement must be fulfilled. So these are the requirements which must be fulfilled in the event of focusing on value added tax. Number one, a supply of goods or services must take place. So VAT to be imposed on a good, there should be a supply of goods and services which takes place. Number two, the supply must be taxable supply, item to be taxed. Number three, the goods or services must be supplied by a taxable person. So there are people who are not taxed and there are people who are taxed. So the goods which are supplied must be supplied by a taxable person. The supply must be made in the course of furtherance of business carried on by the supplier. So when you are furthering your business, like from manufacturing to wholesaler to retailer, when goods are passed on from one point to another, then it will always attract VAT. The supply must be made in Kenya. So when supplies are made within the borders of Kenya, that will always attract value added tax. Now let's look at the history, just the history. It was first adopted in France in 1954. So VAT was first adopted in France in 1954. This tax has also been imposed by other member countries of European Union. For example, we have Germany, Italy, France, and any other European Union countries. Number four, in Kenya, no, being used also in other developing countries, including Kenya. So in Kenya, VAT was imposed in 1989 in replacement of sales tax. So VAT came to replace sales tax. It is charged under VAT Act 1989. The Commissioner of VAT is responsible for effective administration of VAT department. So VAT is under a commissioner, and the commissioner is responsible in making sure that there is efficiency and effectiveness of collection of VAT from business people. Now, terminologies which are used, the language which will help us understand what is all about VAT. Number one is value added. It is the increase in worth of supply when it changes hands in line of manufacturer and distribution. So when goods change hands from one individual to another individual, from manufacturing to distribution, it creates what you call value addition. Number two, tax invoice. It is a document which gives the description of goods supplied, their value added rate, amount of value added, and the total value of goods supplied by a supplier. So when you talk about tax invoice, it is a document which gives us clear detail of which kind of transaction has taken place, how much VAT has been charged, and how much supply has been made. Remission. This refers to the waiver by the Commissioner of Domestic Tax of any tax payable by a taxpayer. So when you talk about remissioning, it is a waiver which is provided by the tax authority. Output tax. This is a tax. This is the VAT charged by registered person when he makes a supply of taxable supplies in the course of business sales transaction. So this is a sale transaction. So tax imposed on sale transaction is called input tax. Output tax. Input tax. This is the VAT charged on taxable person when he acquires taxable supply for use in the furtherance of its business purchase transaction. So when you make a purchase transaction and then you want to add value to the product, then you will attract input tax, which is actually the VAT. Taxable person. This is a person who is liable to supply for registration under the VAT Act. So taxable person is a person who is liable for the supply for the registration under the VAT Act. VAT payable or refundable. It is the difference between the input and the output tax. If the output is more than the input tax, the difference is the VAT payable. If the input is higher than the output, the tax difference is VAT refundable. So you can be refunded or carried forward. Tax period. It means 1 calendar month. VAT is accounted for on monthly basis. So always have this in mind. VAT is normally paid on monthly basis. So if the business took place in the month of January, in the month of February, on 22nd, on 20th, VAT must be paid. Number 8, tax period. It means a calendar month. So we have talked about that. Taxable supply means transacting a taxable goods or services. Supply includes the following: the sale, the supply or delivery of taxable goods to another person. So when you talk about supply, it includes 1, the sale of goods, the supply of goods, or delivery of goods which are taxable. So these are the critical terminologies that we must inform ourselves with. Registration. Registration for VAT. This is the process by which traders who are eligible for registration under the VAT Act are issued with registration certificate. It is important to process because only registered traders are allowed to charge VAT. It is important to note it is an offense to charge VAT if you are not registered. So for you to charge VAT as a business person, you must have received a registration certificate. So you register as an individual. Who qualifies for registration? Any person who in the course of his business has supplied or expected to supply taxable goods or services or both with value which is shillings 5 million or more in a period of 12 months should apply for registration suppliers with a turnover less than 5 million in a period of 12 months are required to pay a turnover tax. So VAT is critical for people who are making a turnover more than 5 million. So you qualify to register for a VAT. So types of VAT, we have normal registration. This occurs when traders who meet the registration requirement applies for the registration and is duly registered and issued with registration certificate. That's number one. Number two type, voluntarily registration. It occurs when a trader who is not qualified for registration applies for registration so as to enjoy the benefit of registered person. It is subject to approval of the commissioner. Number three, registration. Intending traders registration. It occurs when a trader who expects to deal in taxable goods and services applies for registration before commencement trading. Compulsory registration. It occurs when traders who qualifies to register fail to do so. In such case, the trader, once he is identified, is issued with the registration certificate without his application. Tax can also be demanded from him on any sale made in the past. So compulsory, it is a requirement. So if you fail to register and you qualify to register, you will receive compulsory registration. Temporary registration. This occurs when a trader who has not been registered applies to register so as to undertake certain business transaction. He is issued with a temporary registration number. So these are the type of registration under the registration of. Now, at what point you are registered from VAT? It is the process of removing a registered trader from VAT register. Any trader wishing to be deregistered for any reason may apply to the Commissioner of Domestic Tax. Deregistration may be requested on the following grounds. So these are the grounds which will attract deregistration. One, closure of business. If you are closing business, you can do the deregistration. Number two, sale and transfer of business. If you are transferring business to another business people, then you can do the re-registration. Death of a trader. If a trader dies, you will be required to do the deregistration. Legal incapacitation or bankruptcy attract deregistration. Insolvency attract deregistration. Change of business status. Partnership to limited company. You are a partnership, but now you're changing to limited company. That calls for deregistration if the turnover falls below the prescribed limit. Remember, the prescribed limit is 5 million per year. So if it falls below 5 million, then you can request for deregistration.